If you've ever wondered how regular people end up wealthier than supposedly smart investors, this is the answer. It's called dollar cost averaging, and it's so boring almost nobody talks about it. $500 a month, invested every month for 30 years, at the long-term stock market return, gets you over $1.1 million, with zero market timing decisions, zero stress, zero brilliance required. That's the magic of dollar cost averaging. Quick definition: dollar cost averaging is one of the simplest strategies in all of finance. You pick a dollar amount, you pick a schedule, usually monthly, and then you invest that exact amount every single time, no matter what the market is doing. Stocks crashed 20%. You buy. Stocks at all-time highs. You buy. Most people are already doing this without realizing it. Every paycheck, your 401k contribution, buys investments at whatever the price is that day. Here's what it looks like in practice. $500 a month, invested in a basic stock market index fund, at the long-term 10% average return. After 10 years, you'd have around $100,000. After 20 years, around $380,000. After 30 years, over $1.1 million. Same monthly investment, never increased. Just time and consistency doing the work. So why does this work? 3 reasons. 1, it actually lowers your average cost. When markets drop, your same $500 buys more shares, and those extra shares pay off when the market recovers. 2, it removes emotion. You don't have to decide if today is a good day to buy. The decision was already made. You just execute. 3, this is the most underrated one. It turns investing into a habit instead of a decision. The biggest reason most people underperform the market isn't bad picks. It's that they stop investing during scary moments. Dollar cost averaging makes that almost impossible. Let me show you why this matters with a real example. Imagine 2 people in January 2008, each with $50,000 to invest. Person A puts the whole $50,000 into the S&P 500 on day 1, a lump sum. Person B uses dollar cost averaging, investing about $2,000 every month over 24 months. Then the financial crisis hits. The market drops 50%. Person A watches their $50,000 collapse to 30. Painful. But person B is still buying, every single month, at lower and lower prices. By 2012, 4 years later, person A's lump sum is still down about 6%. Person B's portfolio is up 24%. Same money, same market, dramatically different outcome. Because person B bought through the crash instead of staring at it. Same $50,000, same 4-year window. $15,000 gap. That's not because dollar cost averaging was smarter. It's because it was disciplined. It bought when nobody else wanted to. Now let me bust the 3 biggest myths. Myth 1, people will tell you, lump sum always beats dollar cost averaging. Vanguard actually studied this. Lump sum wins on average about 2/3 of the time, by about 2% over a decade. So yes, mathematically, lump sum has a slight edge. But here's the catch: most people emotionally cannot lump sum. They sit on the cash, they wait for a better entry, they miss it. Dollar cost averaging gets them invested. That beats waiting forever. Myth 2. This only works in down markets. Wrong. It smooths out volatility regardless of direction. You don't need a crash for it to work. Myth 3. I need to time when to start. That's the whole point. There's no timing decision. Today is a great day to start. So is next month. So was last year. How do you actually do this? 4 steps. 1. Pick what to buy. For most people, this should be a broad stock market index fund. The exact ticker doesn't matter much, whether that's something like VOO, VTI, or whatever the default option is in your 401k. 2. Pick how much. The exact dollar amount matters less than picking something you can sustain for years without giving up. $20 a month for 30 years beats $500 a month for 3 months. 3. Pick a date. The first of the month right after payday is a classic. 4. Automate it. Set up the automatic transfer with your brokerage, then walk away. Don't check it. Don't tweak it. Don't get clever. The strategy works because you stopped making decisions. Dollar cost averaging isn't sexy. It won't make you rich quick. It won't make you the smartest person at the dinner table. It just works. Pick an amount, pick a date, automate it. That's it.